Everyone thinks a balance sheet is just a snapshot of what a company owns. They're wrong. Most people believe a balance sheet shows you the real value of a company, like looking at a person's bank account and knowing exactly how rich they are. And on the surface, that makes sense. A balance sheet lists assets on one side, liabilities on the other, and equity at the bottom. Assets minus liabilities equals what shareholders own. Simple, right? Except that equation is hiding something critical about how companies actually work. Let's say you walk into a grocery store. You see the shelves, the building, the cash register. If someone told you that's the store's net worth, you'd laugh. But that's exactly what a balance sheet does. It counts physical stuff. A factory, inventory, trucks, patents. The problem is those numbers are based on historical cost, not current reality. A building purchased in 1995 for $2 million might be worth $10 million today. The balance sheet still lists it at $2 million minus depreciation. Then there's the liability side. A company owes money to banks, to suppliers, to employees via pension obligations. But here's what trips people up. Not all liabilities are created equal. A debt due tomorrow carries different weight than a debt due in 20 years. A balance sheet treats them as the same line item. It's like saying your rent and your mortgage are equally urgent because they're both listed on your expenses. Here's where the real story emerges. A balance sheet is a legal requirement, a frozen moment in time, usually at the end of a quarter. It's audited, which means accountants verify the numbers follow specific rules. But those rules are standardized, not necessarily truthful. Two identical companies can show wildly different balance sheets depending on accounting choices, how they value inventory when they recognize revenue, how aggressively they depreciate assets. So what's the balance sheet actually for? It's not a valuation tool. It's a compliance document. It tells you what a company owns, what it owes, and what shareholders theoretically have a claim to, all measured by accounting standards, not market reality. Investors use it alongside cash flow statements and income statements to triangulate the real picture. One number alone tells you almost nothing. Think of it this way: a balance sheet is like a recipe card. It tells you what ingredients are in the kitchen and what you owe the supplier. But it doesn't tell you if the food tastes good, if customers will buy it, or if the chef knows what they're doing. That's why professional investors look at dozens of metrics, not just the balance sheet. It's one lens among many. The balance sheet equation, assets equal liabilities plus equity, will always balance. Mathematically, it has to. But that's accounting identity, not economic truth. A company can be balance sheet healthy and operationally dying. It can have positive equity and negative cash flow. Understanding how a balance sheet works means understanding what it can and cannot tell you. It's a tool, not a verdict. If you're trying to understand how a company actually works, not just its legal accounting position, a balance sheet is the starting point, not the finish line. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next breakdown of how financial systems actually function beneath the surface. Subscribe so you don't miss the next breakdown of how financial systems actually function beneath the surface. This video is for educational and informational purposes only and is not financial advice. Always do your own research.